Market crashes shatter wealth with sudden, violent force. When selling pressure overrides liquidity, asset prices collapse in a matter of days, completely destroying years of compounded capital gains. We saw this exact dynamic during the 2008 global financial crisis. Between November 2007 and March 2009, global equities lost 55% of their value, erasing trillions of dollars from institutional balance sheets. In the aftermath of a severe drawdown, the immediate institutional response is to seek downside market protection. Portfolio managers face intense pressure to ensure that a localized market panic does not result in total capital destruction. This creates a mathematical paradox. The overwhelming urge to buy portfolio insurance to protect against short-term disaster often creates a statistical guarantee of long-term underperformance. To protect a portfolio, investors generally seek inverse market exposure, which profits when the broader market falls. This is accomplished through two primary mechanisms: physical short selling and synthetic shorting using derivatives like options. Physical shorting involves borrowing shares of an asset from a broker, selling them at the current market price, and hoping to repurchase them later at a lower price to return to the lender. However, because an asset's price can theoretically rise to infinity, physical short selling carries unlimited liability and constant margin risk. Institutions seeking true insurance cannot accept infinite risk, so they turn to the defined, capped risk found in the options market. The most common tool for this is the put option. A put option is a derivative contract that grants the holder the right, but not the obligation, to sell an underlying asset at a specified strike price before a certain expiration date. This graph shows the distinct difference between the two approaches. On the left, the physical short exposes the investor to an infinitely steepening loss if the market rallies. On the right, the protective put creates a hard horizontal floor, strictly defining the maximum possible loss. The cost to establish this absolute floor is the option premium. This premium is a cash payment that fluctuates based on the time remaining until expiration and the current volatility of the market. Investors pay this premium specifically to eliminate tail risk. Tail risk refers to the probability of extreme, rare events occurring on the far left edge of a normal distribution curve of market returns. Buying put options successfully amputates tail risk, but the statistical cost of purchasing that insurance introduces a permanent systemic drag on the portfolio's total return. To observe the mechanics of this drag, we can map out a practical scenario. Consider an investor looking to hedge a $1 million equity portfolio against a catastrophic drop over the next 3 months. Purchasing put options transforms an unknown catastrophic risk into a known, quantifiable premium. By paying cash up front, the investor alters the mathematical expectancy of the entire portfolio. Assume this manager holds a portfolio highly correlated to the S&P 500, and they fear a severe 20% sell-off in the near future. The manager allocates $20,000, 2% of the total portfolio value, to purchase out-of-the-money S&P 500 puts. An out-of-the-money option is a contract with a strike price below the current market price, making the premium cheaper, but requiring a larger market drop to trigger a payout. This is a payout matrix comparing the unhedged portfolio against the put-hedged portfolio at expiration. If the S&P 500 drops by 20%, the hedge executes perfectly, restricting the portfolio to a maximum loss of only 3.8%. If the market remains entirely flat, registering a 0% change, the options simply expire worthless. The portfolio absorbs the $20,000 premium loss, finishing down to when market fear is elevated. The VIX spikes, making the cost for insurance highly expensive. Over a strictly short-term, event-driven horizon, paying a volatility premium is a mathematically sound strategy. It amputates the left tail and guarantees survival through a localized crash. The mathematical reality changes completely when this short-term logic is applied continuously over a multi-decade institutional time horizon. Institutions seeking constant protection often utilize the collar strategy. A collar is an option strategy where an investor buys protective puts to cap downside risk, while simultaneously selling upside call options to finance the cost of the puts. This chart displays a 40-year backtest by MSCI. It directly compares a standard portfolio holding 65% equities and 35% fixed income against an identical portfolio layered with a continuous collar strategy. Looking at the top left quadrant, we see that the collar successfully executes its primary mandate. It visibly compresses the overall annualized volatility of the portfolio. But shifting focus to the Sharpe ratio quadrant on the top right reveals a critical failure. The risk-adjusted return of the collared portfolio is significantly decimated compared to the unhedged baseline. The raw cost of reducing that volatility is steep. Over 40 years, the collared portfolio sacrifices approximately 120 basis points in annualized performance. A basis point is a standard unit of measure in finance, equal to 1/100th of 1%. When a portfolio is hedged continuously, the math is absolute. The investor guarantees a lower lifetime yield, paying a permanent tax in exchange for an artificially smooth performance curve. To understand exactly why this happens, we have to look at kurtosis. Kurtosis is a statistical measure that quantifies the probability of extreme rare events, the fat tails or black swans, occurring within a distribution of returns. The data in the bottom right quadrant confirms that the collar works. It successfully amputates the tail risk, significantly lowering the kurtosis of the portfolio. But the statistical trade-off for capping kurtosis is paid in skewness. Skewness is a metric measuring the asymmetry of a distribution, indicating whether returns are heavily weighted toward positive or negative outcomes. Shifting to the bottom left quadrant, the damage is obvious. The light blue bar reveals a massive downward expansion, indicating a severe worsening of negative skew. This specific data point dictates the reality of the portfolio. A worsened negative skew means the portfolio is structurally biased toward more frequent, albeit smaller, negative returns. The underlying mechanics of the options drive this bias. The continuous bleeding of the option premium acts as a persistent negative drag during all flat or slightly upward trending markets. The investor is entirely safe from a sudden 20% wipeout, but their capital is now subjected to continuous mathematical erosion. This is the mathematical trap. By continuously hedging tail risk, institutions trade the rare possibility of a black swan event for the absolute certainty of systemic underperformance. This forces a structural question. Does an investor with a 40-year timeframe even need to protect against short-term kurtosis in the first place? The answer lies in the horizon effect. The horizon effect is a statistical principle demonstrating that the impact of extreme market events naturally decays as the holding period extends. This line graph maps the decay of extreme market risk. As the return horizon on the x-axis extends from 0 to 250 days, the kurtosis drops sharply toward a flat baseline. On day 1, kurtosis is massive, representing the sudden shock of a market crash. But mathematically, that extremity reverts toward the baseline by day 250. We can observe this in the 1987 crash. Despite a catastrophic 31% drop in October, the U.S. equity market actually ended that calendar year with a positive 2% return. Time itself is the ultimate hedge against kurtosis. Paying a constant 2% volatility premium for an event that time will naturally erase is a structurally inefficient allocation of capital. Therefore, the optimal approach to market insurance is dictated entirely by your time horizon. For short-term, event-driven timelines, buying puts remains a valid, necessary tool to cap immediate liability and survive a crisis. This graphic highlights the contrarian reality for long-horizon capital. If time naturally hedges your risk, you should not be buying insurance. You should be writing it. By taking a short position on a collar strategy, the long-term investor becomes the seller of the tail risk hedge. They collect the continuous volatility premium paid by fearful market participants. Capturing this premium naturally mitigates the portfolio's negative skew over a timeline of decades. It transforms the cost of fear into an alpha-generating yield. The options market is a zero-sum environment. For every buyer securing expensive downside protection, there is a seller on the other side of the trade who is mathematically favored by time. Tail risk hedging is never free. Your investment horizon determines whether you are the one paying the toll or the one collecting it.